Hi guys, welcome. This is the re-recording of the class from Monday this week. It was on March 18. Apparently, I had a problem with OBS, so I ended up not recording the session, and I was not aware, so I'm doing the recording again. So today's class is about it's the continuation of the class from last week, Market Maker Model Series, Part 2. In this class, I'll be talking about the further stages of the Market Maker model. So in the first class, I was talking about the consolidations, which is original consolidation and smart money reversal. Excuse me. Before I dive into the next stages of the Market Maker model, let's remember what we learned from the last class. So we learned how interbank price delivery algorithm works and how it delivers the price. So remember, every market price move starts with a consolidation, right? Like there's no exception to that. And that consolidation always leads to an expansion. After the expansion, it either retraces, then expands in the same direction. So this is the continuation price delivery. And then once it completes its objective, it gets back into consolidation. Okay? And on the other side, what also can happen is it could expand. After consolidation, expansion, right? It reverses and expands in the opposite direction. Okay, this is usually the manipulation type of delivery, which you usually see at New York Open 9:30 in the form of Judas swing. Right, it rallies initially and then reverses right away, and for the entire day after that, it keeps expanding in the opposite direction. Once it completes its objective, it gets back into consolidation. This is highly important information when it comes to market maker model because it allows us to understand it fully whenever you can anticipate when the market maker model is completed, or you can have higher probability SMT divergences or failure swings and stuff. Right, so let's remember market maker model profiles as well. On the top left corner, you'll see the buy model profile. Right, it starts with a consolidation, distributes lower, which is the manipulation. At some point, it starts stalling, so price doesn't move, starts accumulating in a short range. This is the smart money reversal range. And then once the accumulation is over, it starts expanding in the opposite direction. The idea of this kind of price action, the buy model profile, is basically after smart money reversal is confirmed, market wants to reprice the marketplace into buy side, which is above the original consolidation. So the high from original consolidation becomes the buy side objective for the interbank price delivery algorithm. So on the bottom right side, there is a sell model profile. It starts with a consolidation, which is original consolidation, expands higher, which is manipulation. And at some point, the price starts stalling. Once the objective of the manipulation is completed, it starts stalling, it starts accumulating, and this accumulation is what we call smart money reversal, right? Once it's completed, it reverses and starts expanding in the opposite direction. Now in the sell model profile, the idea of this price action is to reprice the marketplace to sell side delivery, which is original consolidation low. So the swing low in the original consolidation becomes the high probability target. Once it completes the profile, it gets back into consolidation below the initial target. Here's the chart examples. The buy side delivery, original consolidation, price accumulates and then distributes lower. Once it completes the objective, it starts accumulating in a short range, right? And in that range, it also creates SMT divergence at the lows. So one asset is making lower lows and the other one is making lower highs here. Then price breaks out of that range, confirms the smart money reversal. Once the breakout is there, Now you can say the market is buy profile is in buy profile. Okay, then it reprices the asset to the buy side above original consolidation. Now on the sell profile here on the other chart, price accumulates here, original consolidation, then distributes higher, right? Expands higher. Once the manipulation is completed, it starts stalling at this range. In that range, it also creates an S&T divergence. So one asset is making higher highs and the other one is higher low, making higher lows here. Once price breaks out of that range, so swing high is there, swing low is all the way down here. That is the smart money reversal range. Once price breaks out of that range with this candle right there, that confirms the reversal. Now market is in sell profile. So the interbank price delivery algorithm will reprice the market, the asset, to the sell side. And it attacks the original consolidation lows. Okay, remember. This is the content from the last week's class number 4. Now this week, I'll be expanding your knowledge into the further stages of the market maker model. So remember the first class, market maker model delivers, or it has 3 stages, okay? Stage 0, stage 1, and second stage. Now, stage 0 is not an official name. This is what I personally call it, okay? Which refers to low risk buy or low risk sell conditions, okay? This is not named by ICT. This is just my interpretation, and you don't have to use it like this, obviously. Now, before getting into the stage 0, let's take a look at smart money reversal from last week's class, because I wanna have a recap about smart money reversal here, just because if you don't completely understand the reversal range, you're not going to be understanding. You will fail to understand stage 0, low risk conditions. Okay, so let's remember that. What is smart money reversal? So smart money reversal is a high speed price reversal at a level. So in an accumulation, it starts accumulating, so the price starts stalling after completing the objective, right? Then it can do 2 things. So in this example, you'll see the traditional smart money reversal with S&T divergence at the highs. Okay, once that range from low to high is broken to the downside with this candle right there, now you have the confirmation for the smart money reversal. Okay, now you can say, okay, this is the smart money reversal range, and the market is in sell profile. Okay, the idea behind the smart money reversal is really 2 things here. The first one is smart money accumulates positions, covering their long positions also. And the second thing is the interbank price delivery algorithm traps the traders in this case. So in this short accumulation or small range of accumulation, it tends to, or it wants to, it intends to trap the traders, which essentially generates liquidity, and that liquidity is being used as a fuel, quote unquote fuel, to reprice the market to the downside. Okay, now what I mean by a trap is it comes down to high speed price reversal. So the algorithm will reprice the market in a fast pace so that it does not allow the trapped positions to mitigate their losses for a break even or for a fair market price. Meaning, once the range, smart money reversal range, is broken to the downside, it is not going to manipulate the highs here again. Okay, because in the event of repricing higher here, that means the trap traders, quote unquote trap traders, now they can mitigate their losses for a fair price. Now the algorithm is not going to allow that, essentially. So what happens here is their interbank price delivery algorithm establishes a smart money reversal with divergence. This is the traditional smart money reversal, as I call it, between assets. That is why I highly recommend you to monitor intermarket price action at all times. Meaning, if you're trading indices like I do, you should be monitoring Nasdaq futures with ES futures, or even with YM. Or if you're trading forex, you should be looking at Euro USD along with GBP British Pound USD. Or if you're trading yen pairs, you can look at yen pairs as well. Now, smart money reversals form at a liquidity point of interest, meaning it is going to happen either within a fair value gap, like an old fair value gap, or above old highs or old lows. Because essentially what happens here is before the smart money reversal, the market is in buy profile, right? So it has its own objective. It is going to complete that objective first before market reverses, or before market gets into a consolidation. Now, in this consolidation, interbank price delivery algorithm either traps light positions or forms a divergence between assets. So, two things out, and I call this type 1 and type 2. And so, the type 1 smart money reversal is trapping late positions, and type 2 smart money reversal is traditional smart money reversal, which you see in this figure with SMT divergence. Okay, so let's dive into this week's topic: low risk sell, low risk buy conditions. So to be able to understand the low risk conditions, you have to be able to anticipate a price reversal or a trap in the marketplace. Now, this is the tricky part, because while watching the price action live, it is really not easy to establish a smart money reversal range. You'll get confused, and usually what we do is we are too zoomed in, and we tend to miss this kind of information. So because of that, I want you to train your eyes, okay? So anytime when you're expecting a reversal or smart money reversal, I want you to establish its range before the breakout candle. And the range will be SMT highs all the way down to the low of the range. Now, if it's the trap, like type 1 smart money reversal, like trap positions, then the range will be the short accumulation from high to low, okay? So this range has to be established because the primary objective here is to understand the first stage of market maker model, which is low risk conditions. I'll be talking about what that is exactly in a minute. So essentially, what it means is like return back to smart money reversal or return back to original consolidation is where low risk conditions occur. So here in this example, smart money reversal, breakout, confirms the reversal. And after that breakout, look at the price. What's it do? It does here is it reverses back, or not reverses, I'm sorry, retraces back into this range. Okay, so the first touch, second touch, and third touch. Rejects it, sends lower. So all those touches, these wicks, 3 wicks, are what we call low risk condition, or low risk sell in this case. So stage 0, low risk buy and low risk sell. This is the first stage of any market maker model profiles. Okay, what we call is the low risk sell and the low risk buy. This condition or this stage usually indicates the first pullback right after a consolidating market. Okay, so remember the first class of market maker model. Price always starts a move with the consolidation, right? Whether that be original consolidation or smart money reversal, which is essentially the same thing, in which smart money accumulates positions and cover their old positions as well, and then reverses the market. Okay, so the initial pullback after the first breakout from the consolidation is considered low risk buy or low risk sell. Now, this is mainly because in this stage, traders have the tightest invalidation levels, meaning tightest stop losses. Okay, so if you take a look at the figures on the right side, on the upper corner, you'll see the buy model example. Prices in an accumulation creates a bullish SMT divergence and sends it higher, so it expands higher. Breaks out from the range of accumulation, right? And it starts a retracement back in the original consolidation or smart money reversal range, range high, and sends it higher. So that touch into back into or return back to original consolidation or return back to smart money reversal is what we name stage zero, low risk buy, and it sends it higher. And your confirmation is the breakout from the range. Okay, so here, the candle that breaks out of that range is the confirmation. Now on the bottom corner, this is the sell profile. Price accumulates, creates smart money reversal with bearish SMT divergence. After the SMT divergence is there, it breaks out of that range. What is the range? It's from the SMT high all the way to the low. Breaks out of that range. That is the confirmation and retraces back into return back to original consolidation or return back to smart money reversal, which is the low risk sell condition. So whenever it trades back in the range, it is called stage zero. Okay. Now, low risk sell and low risk buy is the stage where price returns back to smart money reversal or original consolidation. It's the same thing. In the first expansion, you might note an order block, a breaker block, a fair value gap, an inversion fair value gap, a balanced price range, and etc. Meaning, I forgot to mention here, you have to have an advanced understanding and knowledge of all the ICT PDRAs here, because when price starts retracing back in the range, you need to narrow it down to a PD array. So this PD array, this retracement can be into a fair value gap, a balanced price range, an order block, a breaker block, or whatever the case, an inversion fair value gap. Like it can be any one of those PD arrays. Okay. So here, another thing to mention here, like one PD array is not greater than the other one. They're equally powerful. But if you ask me my personal opinion, my personal favorite is the balanced price ranges because it's easiest to see for my liking. There's no way you can miss a balanced price range because what it means is there's a CB and a BC at the same level overlapping, right? There's literally no way to miss that kind of information while watching the price. So the main reason of this kind of pattern in market maker model is due to liquidity, right? In market, everything is built around liquidity at the end of the day, right? Because that's how market moves. It moves from liquidity to liquidity or imbalance to imbalance, right? So because it's built around liquidity, let's remember the high resistance and low resistance liquidity around conditions from the class number, I believe it was 2. So what happens here is when market knocks out an old range, thick price action, here, this is the thick price action, the breakout knocks out all those lows, right? It should not violate the highs again or should not really retrace deeper above its equilibrium of this range because that puts the market in a high resistance liquidity run in which it could go sideways, consolidates a little bit before making a move, or it could reverse and run the highs in this case here in a high resistance condition. So preferably what happens here is after price knocks out the low because it needs to stay in a low resistance condition, it is going to respect the range low or range equilibrium, right? And as long as it stays below it, it's going to be in a low resistance liquidity run condition. So because of that information, now we can say market forms a lowest buy and lowest sell event. And this is the initial stage of a market maker profile, which is why I call it stage 0. So stage 0 is also considered as an inducement, meaning it traps the traders and put a different sentiment in the marketplace, meaning makes everyone think that it's a reversal. So here, if you take a look at this example, this retracement will be rather sharp, okay? And a lot of people will think, oh, this is the reversal, now we should go long. But little do they know is that it is actually a lower sell condition. Okay, don't fall victim to that. Well, let's take a look at a couple examples here. So in this figure, you'll see so in this figure you'll see the market maker sell profile. Price starts with a consolidation, right? Original consolidation, and expands higher. Once it completes the buy profile objective, it starts stalling here, right? Price starts accumulating, spends time a little bit above a fair value gap, a busy here, which is essentially a trapped positions, right? Once price inverts the busy with this candle, now you have the confirmation for smart money reversal. So this accumulation becomes your smart money reversal range. Okay. Now this kind of smart money reversal does not require an SMT divergence at the highs, and as I call it, I name it as type 1 smart money reversal, which is the traps, the trap positions. So I noted here price accumulation, smart money reversal in the form of trap positions, which I call type 1 reversal. Okay, confirmation with the breakout candle, and then it starts retracing back in the smart money reversal range. And that retracement, that touch, the wick, is what we call low risk sell condition, return back to smart money range or return back to original consolidation. Now, the red shaded area, the whole retracement, is considered low risk sell. Not just the touch, but the whole retracement. Okay? Now, if you want to narrow things down a little bit, what you can do is you can combine this range with PD arrays. So what we have here is a SIBI, a BISI rather, overlapping with the SIBI, right? Which what we call is BPR. It retraces back into BPR, and also the range low. So the smart money range low, and then sends it lower, reprices the market to the sell side below original consolidation. Now this is the type 2 reversal in the same profile, the market maker sell profile. What happens here is price accumulates here, original consolidation, expands higher. Once it completes the buy side objective, it starts stalling. So price is stalling, it's not making many moves, stays within the range, and within that range it creates a bearish SMT divergence at the highs. Now this type of smart money reversal is what I call type 2, traditional reversal with SMT divergence. Now once the SMT is there, now you can anticipate the range from its high all the way down to the low, the lowest low of the range, and that becomes your smart money reversal range or original consolidation range. And when the candle breaks out of that range, so the accumulation range is broken to the downside, now you have the confirmation. Any price move after that breakout touching the smart money reversal range is stage 0, low risk sell, return back to original consolidation, or return back to smart money reversal range. Now, you see here after the breakout, the first wick is stage 0. This candle, stage 0 because it's trading in the range. All these price action here in the range is low risk sell. Now let's zoom in into this this price action. It's the same price action, just zoomed in. So what happens here is the breakout candle retraces back in the smart money reversal range, right? So what happens here is you should be looking at this ranges low, equilibrium, and then if there are PD arrays in that range, in that zone, if you want to narrow it down, you can combine both of them all together. So what happens here in this case is price retraces back in the range equilibrium, smart money reversal range equilibrium, and at that precise level, there's also a breaker block, right? So high, low, higher, high, lower, low. The lowest down close candle in that price action here becomes the breaker block. Now, you don't have to use both of them. What you can do is you can either use the PD arrays or the range or the smart money reversal range and its mid-level, equilibrium, and low or high, or This is how I personally do it. I use all together. I mix it together because it gives the most precise level, right? If I see a PD array at range equilibrium like this, that I know, I narrowed things down for more precise entry, because if you're looking at the range, like high, low, or equilibrium, it is one level, right? It's not a zone like breaker block. It's not a zone. It's just one precise level. So I like to combine the two, because sometimes you also don't get PD arrays like this. So it doesn't look clean, or it looks as if there's no PD arrays in that price action or whatever. So in the event of price not being too clean, you can just use the range. It's equilibrium low and high. But if you see a PD array which can be like too obvious for you, you can combine the two. So every time price touches the range here, or trades within that range, that is what we call stage zero, return back to original consolidation, or return back to smart money reversal range, also called lower sell. Let's take a look at another example here. This is the buy profile example, type 1, smart money reversal in the form of traps. So price accumulates here, original consolidation, distributes lower. Once the sell model is completed, it starts stalling here. In this price action, what we see is price accumulates below a CB, and immediately after the accumulation is completed, it it violates that CB, so it inverts it. So that candle here, this one, is the breakout candle, which confirms the smart money reversal, right? And this reversal is price accumulation, smart money reversal in the form of trapped shorts. So this accumulation is there to just trap people, which is type 1 smart money reversal. Um, so the accumulation range becomes the smart money reversal range from high to low, breaks out, and immediately after, it retraces back into the accumulation range, return back to original consolidation. So the rate traded area where price touches or tests the accumulation range becomes stage zero, lowest buy, return back to smart money reversal range, or return back to original consolidation range. Now, if you combine that information with ICT PD arrays, there's a SIBI overlapping with BISI. That could be your first point of interest. You can narrow it down to smart money reversal high and use that precise level along with BPR. Or there's also accumulation fair value gap and IFED fair value gap within the range. You can narrow it down to that as well. And then what happens after that is lower SPY, and it reprices the market to the buy side above original consolidation. Another example on the buy side, buy model. This is with type 2 smart money reversal, which is what I call traditional reversal with SMT divergence. So what happens here is price accumulates, creates an original consolidation, breaks out, trades lower. Once the sell profile is completed, it starts stalling, starts accumulate, it gets into consolidation here again, and in that consolidation, it creates an SMT bullish SMT divergence here, right? And then, so this is the wrong annotation. I should mention that. So the range of the smart money reversal is low to this high. This is a wrong annotation, so it should be this high here. And with this candle, if you look at the high, it breaks out of that range. So this candle becomes the confirmation, not this one. Wrong annotation there. This candle becomes the breakout of the smart money reversal range, confirmation, and immediately after it retraces back in the range, right? These candles are now trading into smart money reversal high, and that which becomes the state zero lowest buy, return back to original consolidation, or return back to smart money reversal range. Then immediately after market reprices the price to the buy side above original consolidation. Now, if you want to narrow things down, you can combine the range high with PD arrays. Now, there are a couple things here. The red shaded area is the fair value gap, BC. That could be state 0. And there's also a breaker block here, high, low, high, high. Breaker block here, actually low, high, lower, low, higher, high. That could be another point of interest, or you can combine the two, or you can combine three of them. Smart SMR range high along with fair value gap, or SMR range high along with breaker block, or SMR range high along with breaker block and fair value gap. Okay, one or the other is not greater; they're both equally powerful. Whichever is easiest to see for you personally, go with that. Here's the key takeaways about state 0. State 0 begins once smart money reversal is completed. So the breakout candle has to be there. That is your confirmation. And price moves away from the accumulation range. Lowest sell, lowest buy, lowest sells can form with any ICT PD arrays. Like I mentioned, it could be any PD array. Could be a break block, order block, fair value gap, and all that. As well as, this is the important part, price does not have to pull back to accumulation range or smart money reversal range. Okay, so state 0 doesn't necessarily have to be on the chart. So price does not have to return back to original consolidation, return back to smart money reversal range. Now there's a reason for that as well. The reason being, when the market, so let's take a look at this example. When the market is, or when the asset is way too strong in the buy model, it usually don't, or sometimes doesn't return back to original consolidation, which indicates strength. So in the event of not returning back, there's no state 0. And on the sell profile, what happens is sometimes it doesn't return back to smart money reversal, which indicates weakness. Okay, so it doesn't give state 0 in the market maker profile. So state 0 does not have to form every time. Just to be aware of that. Okay. If you're always trying to catch state 0, I'm like pretty sure, like 100% sure that you'll miss some moves. State 0 is considered low risk mainly due to it's the very early stage of the expansion, right? You're literally buying or selling price before the initial expansion. So you're buying or selling the manipulation. Now, our goal as traders is to establish smart money reversal range and anticipate a pullback to that range. Okay, this is the tricky part. Establishing smart money reversal range during live session is not an easy task, and you need to have experience, you need to have chart time to be able to do so. Okay, so in the first place, this might be quite frustrating initially. You might miss moves, you might anticipate wrong and stuff like that. Don't just beat yourself for that, okay? This is not an easy task by any means. Now, if price retraces more than equilibrium of smart money reversal range, the odds are against you because the market is in high resistance liquidity run. Now, what I mean by that is essentially, let's take a look at this example here. Equilibrium range of smart money reversal is like around here. Okay, if it retraces more than that, so if it retraces like below that equilibrium of the range, that means market is either in a high resistance liquidity run condition or it's going to go sideways. Okay, because preferably you don't want to see that. Why? Because remember, the stick price action should not get violated for low resistance liquidity run. So price needs to stay above it, needs to provide quote unquote support, right? Now on the sell profile, it's going to be the other way around. It should not trade above equilibrium of the range here. Okay, if it does, if you see that happening, just stay flat because you'll probably end up getting chopped. Hold on 1 second. This is a noise outside. I gotta close the window. Okay. Now, first stage accumulation, first stage distribution. So, actually, let me go over this real quick. So, what accumulation stands for in the market maker model is essentially the buy side expansion. It stands for accumulation, and sell side expansion to the lower is called distribution. Okay, so what we're going to do is we're going to be focusing on accumulation for buy profiles and distribution for sell profiles. Now here, what we're going to do is, so last week our main focus was the original consolidation and smart money reversal. Now now today, with first stage, what we're going to do is we're going to be focusing on the first stage accumulation, which is this blue shaded box, the first expansion after reversal. Same thing here, the first expansion after reversal, right? The red shaded box. That's going to be our primary focus for today's class. Now, what is the first stage in the market maker model? Now, the first stage of the market maker model initially is the initial leg of the first expansion, right? Now, what we're going to do here is we're anticipating the expansion after the first reversal, and you're going to be seeing that better in the charts in a second. Now, accumulation refers to expansion on the buy side of the curve, and distribution refers to the expansion on the sell side of the curve. First stage starts with a pullback after stage 0 if present. Remember, stage 0 does not have to be have to form. Okay, if market is way too strong or way too weak, usually sometimes you don't get that. So it starts with first stage. Okay, but first stage is always there in the market maker model. So the pullback that initiates the first stage expansion always return back to an ICT PDRA, and that PDRA could be anything again. It could be a breaker block, order block, fair value gap, BPRs, emergent fair value gap, all that, which is why you have to, you want to completely understand, you have to know all the ICT PDRAs to be able to understand market maker models and its delivery stages, okay? Now, the first stage of market maker model is never the most energetic expansion. There are more stages in a market maker model profile, which is more energetic than the first stage. Okay, that's not going to be the topic for today's class, though. Now, the objective of the first stage is to send price into a range of equilibrium or higher, and first stage never aims to engage with the market maker model's main target, which is original consolidation high or original consolidation low. And because of that, in this stage, usually the main target is internal range liquidity in the form of internal range high or low or fair value gaps. Okay, now let's take a look at the examples here, the visual representations. So on the upper side, on the top side, you'll see buy profile, price consolidates, distributes lower. In that distribution, it starts stalling again and creates smart money reversal, right? It expands higher. The first breakout, return back to original consolidation. Here, this is lowest buy, stage 0, and then after that it expands. This is the first expansion leg in the market maker model, right? Once the expansion high is set, expansion leg low is set. Now you look for the dealing range. Within that dealing range, what's going to happen is price will either retrace back in the range equilibrium or the discount PDRAs. Now that PDRA could be any form, breaker block, order block, fair value gap, or others, right? And that PDRA retracement or range equilibrium retracement is what we call the first stage accumulation in buy models. Now on the bottom side, you'll see the visuals for the sell profile. Price accumulates here. Oh, also I forgot to mention, the objective of this first stage is usually to take out the short-term highs or internal range liquidity here, which you'll see better in examples, chart examples in a bit. So on the sell side of the curve, if you look at the bottom figure, so price consolidates, sends it higher, it starts stalling again in this accumulation, starts reversing, creates a smart money reversal pattern, breaks out of that range. Now that first retracement into a PDRA outside the smart money reversal range is the first stage distribution. Now that PDRA is going to be in a premium side of the market or range equilibrium, okay? And PDRA can be anything, breaker block, order block, fair value gap, BPR, etc. Then it sends it lower. Now the idea of the first stage is, or the aim of the first stage is, it will either target range equilibrium for marginal consolidation, the smart money reversal high, range equilibrium will be the aim, or the goal will be the internal range liquidity here. That's low, all low, okay? Or maybe if there is a fair value gap present below that low here within the original consolidation, that will be the aim of the first stage distribution, okay? Now, also in this figure, I did this specifically. There is no stage zero, so price breaks out and never returns back to original consolidation, never returns back to smart money reversal range. So you see that? That the reason I did that is because you don't have to get a stage zero delivery all the time. And let's take a look at an example here. This is the sell profile. So market consolidates, accumulates here, sends higher, expands higher, and once the buy side delivery is completed, it starts stalling, starts accumulating. Not accumulation, market provides or forms a bearish SMT divergence at the highs, which is, excuse me, type 2 smart money reversal, traditional SMR, right? So the range will be from the high to low, right? The breakout of that low, which is this candle, confirms the smart money reversal, okay? And what happens here is it kind of stalls here. The first fair value gap, whenever it touches there, that is the stage 1 distribution in the form of a fair value gap, right? This is time distortion. It turns back one more time to fair value gap CE, the mid level, and sends it lower, reprices the market to the sell side. Now, the objective of this move, first stage distribution, is essentially knock out the short-term sell side and trade into range equilibrium right there. And also maybe internal range liquidity. These fair value gaps could be potentially targeted for the first stage distribution. Now in this example, if you take a look at the traditional SMR range, price never retraces back into the original consolidation range. You see that? That indicates weakness in the price in the market. There's no stage zero delivery, so there's no low risk sell. Now this whole red shaded area from the first touch of the fair value gap all the way to here is the first stage distribution. Not only the touch, but the whole price action, okay? Now this is the same example, and this is the most important part in my opinion, and where people get confused the most. This is the same price action as this, just on a relatively higher time frame. So what usually happens with the first stage distribution or first stage accumulation with the market maker model is essentially it forms a higher time frame order block. That is the objective of the first stage in the higher time frame perspective. So what you have to do is when you want to enter or execute in the first stage, whether it's the buy side buy profile or sell profile, you have to anticipate a relatively higher time frame order block, because that's how you get to execute in a timely manner, okay? And traditionally, the way to do so is essentially like you anticipate the order block. So what happens is after distribution, usually it forms an order block in the form of two up close candles. Okay, usually it's two consecutive candles. Okay, if you can time that on the second consecutive candle, you can try to go short within the point of interest on the lower time frame. Okay, and this is the hard part. And sometimes you'll see me like saying, wait for the next 15-minute candle because it's going to be an up close candle, and that's the reason behind it, because I'm anticipating an order block there, because I know in the context of market maker model that it's the first stage of the delivery, meaning it's going to print market will form an order block on the relatively higher time frame, which is essentially the idea behind that is essentially it is building an order block to keep the order flow. Why? Because the order flow will, if it's bearish, it's not going to violate the order blocks, right? It's going to keep price intact. Now, in this case, it was like 5 or 6 up close candles here. That is usually not the case. It happens sometimes, but if whenever the market delivers cleaner, it's usually one or two candles in the form of order block on the relatively higher time frame. So, as a general rule of thumb, if you notice a market maker model on the 1 minute, you should be anticipating order blocks at its first stage on the relatively higher time frame, which is 5 minute. If you spot a market maker model on the 5, you go one higher time frame, which is 15 minute. You need to anticipate a 15 minute order block before executing on the first stage. Now let's take a look at the buy side example. Price accumulates, sends it lower. Once the sell side delivery is completed, it starts stalling, right? Accumulates. In that accumulation, it forms an SMT divergence, bullish SMT divergence at the lows, right? So the traditional this is the traditional form of smart money reversal, and the smart money reversal is now established from this high all the way down to SMT low. Price breaks out of that range. Now that is the confirmation for the reversal. So whenever it touches back into range high here, that is the state 0, lower SPY, so the red shaded area, this wick, state 0, lower SPY entries. Now those wicks are also trading into a fair value gap here. You can narrow it down to that. And also there is a breaker block here, trading into that. Another ICTPTR, you can use either or you can combine them both. And then it expands one more time. Now with another expansion, after the lower SPY, stage 0, it retraces one more time into a fair value gap here. That becomes the first stage accumulation. The CE of this fair value gap here becomes the first stage accumulation. Now here's the thing. Because first stages will never deliver all the way to the original consolidation high, what you see here is it starts retracing or forms the first stage of market maker model before taking out the internal range low. You see that? Because that is the aim, that is the objective of the first stage delivery. So this internal range high, internal range liquidity here as well. Those will be the main objective of the first stage delivery, okay? And also this fair value gap could be, because at the end of the day, imbalances are also internal range liquidities, and it sends it higher afterwards. So if you see that this internal range of liquidity is taken out, now it's in the second stage of the market maker model, sends it higher, which I'll be explaining later next week. Oh, it's the same price action on the higher time frame, right? Smart money reversal, breakout, lower sell, another breakout. Now here, if you look at this candle right there, you're technically buying the pullback, the wick. See that? So this is the golden shaded area, same fair value gap here. You're buying the manipulation here on this candle. Now, here's the thing. This is what you need to anticipate before entering at the first stages, okay? There's an order block here. It trading into that order block and sends it higher. This is the hard part of first stages. You need to anticipate those pullbacks. Now, two things can really happen. First, the market is either creating an order block and you're in the first stage of accumulation or distribution in the market maker model context, or an individual candle is manipulating during the first stage on a lower time frame. Okay, so a higher time frame pullback becomes the first stage market maker model delivery, if that makes sense. This is the confusing part, but I'm sure once you dial in more and get the experience you need to have, you'll understand it better. You'll see it yourself during your back testings as well. And the key takeaways here about this first stage is first stage of market maker model can be delivered by utilizing any ICTPTR. So any stage of market maker model is essentially using all the ICTPTRs, whichever is present in the marketplace. Okay, it doesn't have to be a fair value gap all the time. and the first stage starts before an internal range of liquidity gets taken out. The reason is internal range high or low becomes a breaker block for later stages of market maker model. So if you think about it, this internal range high becomes what? Breaker block for this. See that? And that is the later stage for market maker model delivery. And if you look at the example here, this example, the first stage is not as energetic as this one. See that? So that's what I meant in the first place about energetic expansions. The first stage is not the most energetic move in the market maker model. The first stage of lower time frame market maker model is always a pullback on a relative higher time frame. The pullback could be an individual candle manipulation or an order block, okay? Because relatively higher time frame is forming an order block. When trading the first stage of market maker model, you have to be able to anticipate the relatively higher time frame order block before your executions, or else the timing of your execution will be way off. Meaning, if I get back to this example here, what will happen is you say you entered at this wick, sold off. Now you moved your stop loss at break even, and later on you get stopped out. So if you don't anticipate this order block here, you're not going to be having the best position management. Or maybe what you'll do is you don't even look at the higher time frame order blocks. You'll execute in this fair value gap here, and it'll get stopped immediately. Why? Because at that point of the market here, there are no order blocks, meaning the order flow has not started. It's going to go from order block to order block. Remember that, the order flow. Here, if you look at this leg here, so order block, sends it higher, another order block, sends it higher. So these order blocks are quote unquote securing the order flow. And the aim of the objective of the first stage of market maker model is either to trade into a range equilibrium or take out the internal range of liquidity. A first stage accumulation or first stage distribution does not require an SMT divergence. Okay, I mentioned this here because later stages of market maker model it usually requires SMT divergence, but the first stage is not the case, because the manipulation has already taken into place in smart money reversal. If you think about it, it's still close proximity to the manipulation here. See that? First stage, the manipulation already happened, and it's still at a close proximity to that manipulation. Because of that, the algorithm will not manipulate one more time. Thus, it does not require an SMT divergence. Let's take a look at more examples here. This is NASDAQ chart on a 15-minute time frame. So what happens here is price retracing back into 15-minute CB / fair value gap here, respecting the CE. Let's go back to down to 5. So on the 5-minute, what happens is price consolidates initially. There's probably SMT divergence at the lows here, expands higher. Now there's a buy side delivery here, and the objective of this buy side model, buy side profile, is to rebalance the market, meaning to trade into a fair value gap. Once it completes that objective on the buy side delivery, it starts stalling, creating an accumulation zone, and that accumulation, it forms another SMT divergence, bearish SMT divergence, indicating the buy side delivery is now completed. Expect a sell side delivery, and then if your price is lower, it creates the sell side of the curve. This is buy side of the curve and sell side of the curve. Now let's go down to 1. You'll see more candles printed here. So what happens here is the smart money reversal range is from high to low. Here, high to low, breaks out. Okay, returns back to breaker. Why breaker? High, low, high, lower, low. This becomes the breaker, and that becomes the first stage distribution. It sends lower. Okay, now the objective of this initial sell-off is two things really: take out the short-term sell side, this low, and more or less the range EQ is somewhere here. The other idea of or aim of the first stage is to get down into range equilibrium. Okay, in this case, it sold off because it was weaker apparently. And also, stage zero, lower sell, return back to smart money reversal after the breakout. This is a wrong annotation actually. This range is wrongly annotated, but it's fine. I'll fix it. Because I'm looking at the 5 minute range, and apparently I did not change it on the 1 minute, but the 1 minute range becomes from the order block to high. So it breaks out here, in here. This is another example. So original consolidation, essentially smart money reversal, distributes lower, breakout candle, confirms the smart money reversal on the south side of the curve. It retraces back in the smart money reversal. This becomes the first stage distribution in the form of a fair value gap. Then it reprices lower. It creates an order block here. It's used just for the second stage, which I'm not going to talk about today. And it comes down here, completes the sell profile, sharp turn. That sharp turn causes an accumulation, consolidation. Now in that consolidation, market provides or forms a bullish SMT divergence, at the lows. Essentially, this is the smart money reversal, sets the stage for the buy model. Now we're in the buy profile, buy side of the curve. This is the range high, range low. You can also take this one as well if you want to. Breakout candle here, breakout candle. Immediately after, returns back to smart money reversal. Return back to original consolidation, which is stage zero, lowest buy. It expands higher, forms the new dealing range from order block to the expansion high. So now you have a dealing range. That dealing range equilibrium is this level. Now you see a discount fair value gap here. It traces down there, which becomes the first stage accumulation in the form of a fair value gap and descends higher. It prices the market to the buy side and completes the buy model. Another example, original consolidation accumulation, breakout, return back to original consolidation, stage zero, lower sell, distributes one more time. There's a fair value gap here. Now every test of that fair value gap becomes the first stage distribution and sends lower. Now once the sound model is completed, it starts accumulating, forms a smart money reversal, traditional smart money reversal, forms a bullish SMT divergence at the lows. After that SMT divergence, it breaks out with this candle as a confirmation, breakout candle. Immediately after, it returns back towards the consolidation, which is lowest sell. Lowest buy. Now we are on the buy side of the curve. It expands higher. In that expansion, forms another order block here, right there. This order block becomes the first stage accumulation, and that sends the market higher, knocks out all the internal range of liquidity here before retracing. Now that retracement is setting up the stage for the second stage delivery, which is not the topic for today. I'll be talking about it later on. But here you can see clearly, like, you cannot be sticking to one PDI or the other. You need to be fluid about it. I think I wanted to mention something here. I forgot. Well, anyways, another example here. This is I don't know. The picture is kind of off. It was not supposed to be like this. I'm gonna fix this though. I have all these figures in my computer. So if you look at the south side of the curve, there's original consolidation here. Breakout candle confirms the reversal. So these trend lines are the breaker blocks of this range. It's not visible here, but that's what it stands for. It tests that breaker block, which becomes the first stage distribution, sends it lower. Once the sell side is completed, the sell side objective is completed, the price starts accumulating again, starts stalling. That accumulation, market forms a bullish SMT divergence at the lows. breakout candle. So that range is being broken to the upside. Breakout candle confirms a smart money reversal. Now we are on the buy side of the curve with that confirmation. It expands the first fair value gap. CE of that fair value gap becomes the first stage accumulation. Okay. Now the objective of this stage is to knock out the internal range high here, which it delivers. And later on, if it wants to, it can go all the way to the other internal range liquidities in the form of imbalances here. Now, one thing to note, in this case, there was no low risk buy condition. Price never returned back to original consolidation. As I mentioned, this happens when the price is way too strong, okay? It doesn't have to return back to original consolidation. If it doesn't, it's actually even better because now you know that price is in a low resistance liquidity run condition. And then it reprices the market to the buy side above original consolidation and complete the buy model, market maker buy model. Now this is a chart from, I believe, Friday last week, an hourly chart from Nasdaq. It's in its most recent price action. So what happens here is price starts accumulating here, forms an original consolidation in this range, right? Breaks out of that range. You can take this candle as a breakout candle because range is from order block to all the way down low, right? Breakout candle, return back to original consolidation. Now all these returns here, even these ones, becomes the state 0, return back to original consolidation. And then this is 3 consecutive down close candles is the order block, first stage accumulation. Price uses that. Now these wicks are permissible. It's just doing the damage. As long as bodies are respecting the order block, that's what matters. And sends the price higher. In that expansion, in the new expansion leg, it forms a fair value gap. That fair value gap becomes the second stage. It delivers the price to the lower portion of the hourly CB, a fair value gap, and completes the buy model. Now, one thing to mention here, guys, I think I've never mentioned this, I believe. So the market maker model will have 2 objectives, okay? 1, to engage with the liquidity. 2, to rebalance the price. So sometimes you're not going to be targeting original consolidations, but what's going to happen is you're going to be targeting imbalances. Now this type, I don't like to trade it that much because for me personally, targeting original consolidations is way better and way easier because it's easiest to see, it's more obvious, okay? In this case, you technically don't know whether price wants to rally to fair value gap high, CE of the fair value gap, or low of the fair value gap. But whereas in the traditional type, when it's targeting the original consolidation, when it's targeting liquidity, it's one level. You know when to exit. That's why I like it more. And also, I annotated the lower portion of this fair value gap because there's a breaker block here, which should not get violated as well. And there's also this thick price action. So that range low should technically stay intact as far as it wants to stay in low resistance condition. That's why I just annotated the lower portion of this high BC. This is the lower end. So this is equilibrium of the fair value gap. Above it, upper portion. This is lower portion. Its CE is 25% of the huge fair value gap, respecting. So price accumulating here, forming the type 2, type 1 smart money reversal, which is trap longs. It's accumulating above a BC. That BC is getting inverted, right? Once this is the breakout candle here, that BC get inverted. This is the confirmation, and starts retracing back. But before that, I forgot to mention here, this fair value gap later on is being used as stage 0 lower sell without the confirmation. This is like highly advanced lower sell entry. Okay, retest of the hourly CB. This is like where you need to really anticipate everything before it unfolds. It's a very very hard catch. Like the safest thing to do is wait for the inversion fair value gap here. because that confirms the smart line reversal. Then it retraces, forms order blocks, traces back into CE of the inversion fair value gap, which ends up being the first stage distribution, sends it lower. Now the first stage distribution's aim, the objective, is knock out the short-term sell sides here, which it does. And then if it wants to, it could also like range equilibrium somewhere here, this level, knocks out that. Also, it could target these lows as well if it wants to, without taking the original consolidation sell side. Okay. Then after it completes its objective, starts retracing back. Now in this retracement, you can see the order blocks here. These order blocks are there for just to keep the order flow intact, essentially. What happens is it retraces back into the breaker block, right? Low, high, high, low, higher, high, lower, low. This candle's tail becomes order block. Order block's mean threshold is being respected, which ends up being the second stage redistribution in the form of a breaker block mean threshold. It sends it lower, completes the south side of the curve. Now, before I get into the trading exercises, I actually want to go over questions because during the live session there were questions, so I want to answer them for the sake of this recording. Here I'll put this here so you guys can see it as well. I'll do, okay. Live stream and the class file. Okay, it's here. Class 5. So soft sell asks breaker plus fair value gap to the unicorn entry. Yes, it is unicorn model. In your model, it appears that you believe the original consolidation is more important than PD arrays. So my answer to that, so basically what he's asking is, for the state 0, he's asking whether this fair value gap is more important than range high. For me, I like to combine the two, because that gives me the most precise level. Okay, so I like to combine range high with a fair value gap, or range high, range equilibrium with another fair value gap. How far are we meant to treat price safe when price goes back to original consolidation? So what Killer Whale is trying to ask is about these wicks. He's asking how far it should go. Now, think about the liquidity class. If price wants to stay in a low resistance condition, this is essentially a thick price action. It should not violate it. Okay, so the furthest it should go shouldn't be more than equilibrium with the range. So equilibrium with this range should not be violated. If it does, it is in a high resistance. It stays in a high resistance condition, and it probably will go sideways or runs the south side in the form of high resistance run. So the wicks are permissible as long as you don't see the bodies. Okay. How to efficiently find the trap longs or sells. Here, price accumulates above a BISI, right? Doesn't move, it just stays in a short range, right? The general rule of thumb is it has to be above a CB or a BISI, like above a BISI or below a CB. Once it inverts the fair value gap, this is essentially what I call like accumulation fair value gap, because it's essentially what it does is price accumulates above it. Once it inverts, disrespects, violates, that is the confirmation for trap longs. And in this type of a smart money reversal, you don't have to have a SMT divergence. Do we need to be considered about the volume imbalance? Volume imbalances, I do not consider them as much because like I use them as a confluence. If price is respecting the volume imbalance with bodies, that's good. I like to use them as a confluence, but I don't use them as a point of interest personally, because you need to be more flexible about volume imbalances. Gosh, I hope I'm pronouncing your name properly, brother. So he's asking, not sure if you remember this, but a couple weeks ago you mentioned on a live stream when marking up a market buy model and its dealing range, it is important to note the EQ of that range and the amount of time spent there on the buy side of the curve. Can you explain why the amount of time is important and what it tells us? Sure, that is a great question, by the way. So the range equilibrium is like very important because if you see price consolidating above it or like around the range EQ, it usually means that we are in a high resistance condition and price might reverse. So it means you might be trading the pullback. So if you think about this price action here, from high, low, imagine the dealing range. The equilibrium of the range is somewhere here at the breaking block. Like this red line, let's say that's the EQ of the range. Now what happens here is it's respecting from high end, and then it's respecting from the lower end. It's just wicking, okay? So that indicates price is going to move. But sometimes what happens is it actually moves around it with bodies. So you'll see bodies are disrespecting from above and from below the range EQ like several times. That usually indicates a choppy price action. That's why it's important to journal the amount time spent at around range equilibrium, because essentially that's a consolidation. Meaning, if this was to trade the sell side, remember the price delivery algorithm, how it delivers, distributes lower. The last leg is the expansion. Is the consolidation, right? That usually indicates price is complete the objective. So in this case, it becomes a retracement consolidation. Now it needs to expand in the same direction. So that's what it means if it starts chopping around the range equilibrium. Okay, so that was all. Okay, cool. Wow, I'm glad I made it. Now let's get to the exercise. So this week's exercise is I want you guys to find a market maker model, whether it's buy side or sell side, and I want you to establish its original consolidation, smart money reversal, establish the dealing range, look at its both buy side and sell side delivery. Okay, so it has to look like this: both buy side of the curve, sell side of the curve. Okay, and annotate its stages in both sides of the curve. Meaning, what I want you to do is I want you to annotate the first stage accumulation, disregard the second stage, but I want you to annotate the first stage and stage 0 if it's present in the market, okay? If it's not present stage 0, then you can disregard that. Just focus on first stage. And then check for reused order blocks, meaning, so there's an order block like here, right? Buy side of the curve. Just draw the opposite side, the opposite end of it in time and see if it was reused on the south side of the curve. Okay, that's what I want you to do. Once you annotate the stage 0 and first stage, disregard the second one for this exercise. Go on the relatively higher time frame and try to understand what was going on in the relatively higher time frame. So try to see whether on the relatively higher time frame, whether it was creating an order block with the market maker model's first stage, or whether it was an individual candle manipulation, right? And then try to understand or observe, is it revisiting a certain level or a PD rate on the higher time frame? Okay, so here's the example. This is what I want you to do essentially. Original consolidation, smart money reversal, establish the range. Then on the sell side of the curve, look at how the sell side delivery was in terms of its stages. So stage 0, return back to original consolidation. First stage distribution, return back to in the form of a fair value gap, right? Accumulation. On the buy side of the curve, once smart money reversal is confirmed, now we're on the buy side. Look at its stages as well. Okay, this is the type of chart I want you to make, and I want to see similar charts in the exercises channel. Okay, but so far this is it, guys. I hope you find this class insightful. I'll see you on the next one.